Morning, everyone. Thank you all for taking the time to participate today. As you all know, it's obviously our final presentations, and I'll be just going through some important things. So to start off with, just a bit of background information. So in the fund management setting, fund managers trade their portfolios to meet liquidity provisions, rebalance their portfolios to take advantage of information, and trade based on speculation. But such motives for trade do not seem to explain the high magnitude of trade we observe, or the willingness of some investors to actually incur large transaction costs that they need to pay sometimes to make such trades. So as I've found, the trading volume in the fund industry is vast. For illustrated purposes, from 2015 to 2021, the average quarterly turnover for US funds was 88%, and specifically 78% for diversified domestic equity mutual funds. So these high trading levels are a real problem, especially when the outcome of this overtraded portfolio generates suboptimal net performance. So studies have shown that investors who trade too frequently tend to underperform. Carhart finds that active funds have high portfolio turnover rates, which hurts their subsequent net performance. In addition, he suggests that this underperformance is due to the high transaction costs incurred by managers when they trade frequently. He finds that the bid-ask spread is very close to the trading costs of 0.21% for purchases and 0.63% for sales paid by mutual funds. To quantify this in economic terms, a minus 0.01% worse performance due to excessive trading actually occurs to an average yearly investor loss of 2.8 billion. So this issue bears important implications. Why are fund managers allowed to trade in such great volumes, incurring high transaction costs and hindering performance? What are the motives behind a fund's high portfolio turnover? So it is unlikely that the theories describing the rational trading needs of fund managers explain the high trading volumes that we observe. Rather, a possible explanation for the high trading levels is the fund family, which is actually encouraging high turnover among their active offerings in pursuit of high returns. Following Nada, Wang, and Zhang in 2013, I believe that fund families offering predominantly active products allow their managers to trade frequently as they aim to generate star performance and attract fund flows. Thus, in the search for stellar performance, it is instrumental for funds to engage in high-risk trading strategies, as it provides them with a better chance of exploiting mispricings in the market and ultimately hitting the top performance rank. Following the previous intuition, I test the following three hypotheses. High trading frequency by funds has a negative effect on their performance. Active funds offered by fund families with a higher asset-based concentration in the active management segment are traded more frequently, and this is consistent with these families engaging in high-risk trading strategies as they attempt to generate star-performing funds to attract fund flows. Moving on to the objectives. So this thesis aims to provide the first empirical evidence addressing the implications of the driving factors behind the underperforming high trading strategies implemented by mutual fund families. I explore the specialization decisions by fund family as reflected by its asset-based concentration in the active management segment. Specifically, I examine the impact that such decisions have on the excessive trading levels by equity mutual funds. More importantly, the study also provides evidence on the differential strategic behavior of active versus passive fund families when generating stellar performing funds and the implications to families and investors alike of such strategies. The importance of such an issue is reinforced by the belief that investors first identify a fund family and then choose among the mutual funds offered. Therefore, a fund family's choice of asset-based specialization in the active or passive management segments affects an investor's wealth across family funds and exposure to family level risk. Moving on to my empirical testing of three hypotheses mentioned earlier. The study starts off with the assumption that high trading frequency generates negative net performance. Therefore, it is necessary to replicate past studies to show this negative relationship. Following Kremers and Parekh, I conduct a set of pooled panel regression where the performance alpha as derived from the Carhart four-factor and DGTW model is the dependent variable, and the fund duration is the main independent variable of concern. Along with this, as shown in Kremers and Parekh also, I control for fund T&A, operating expenses, and fund age. From this, I expect to observe a positive relationship between the alpha and fund duration, as Kremers and Parekh and other studies have found in their research. And obviously, this will suggest in favor of the assumption that higher trading levels have a negative effect on net performance. Moving on to the main test of my hypothesis, the active funds offered by families with a higher level of activeness, or rather higher asset base, are likely to be traded more. A panel regression is incorporated. As shown in the slide, I conduct a variety of 3 different panel regressions, one for each of the trading frequency measures in order to ensure robustness. These trading frequency measures include the fund duration, which determines the time in quarters that on average funds hold on to their stocks in their portfolios. The fund holdings turnover, which measures how frequently a fund rotates its positions on their portfolio, and the turnover ratio, the turnover ratio of the fund as declared by CRSP. Each of these trading frequency measures are regressed on the main independent variable concern, the ACF, to whom the active fund is offered by, plus a bunch of control variables, as well as fund, family, and time-fixed effects. This model will provide an indication regarding whether active funds offered by families with a higher level of activeness are traded more often. Basically, I expect to observe a negative relationship between the fund duration and family activeness, which would suggest that active funds of more active families hold on to their stocks less, suggesting they are traded more frequently. However, a positive association is expected to be observed between the other 2 trading frequency measures, the fund holdings and the turnover ratio, and the subsequent family ACF. This will demonstrate in favor of the proposed hypothesis, as active funds offered by families with the higher active asset base concentration are likely to have higher turnover ratios. Moving on to my results. So this is just a bit of a table of context of the results that I provided, targeting each one of my hypotheses. So I start off with pooled panel regressions. Then I move on to studying the relationship between active funds trading frequency and its affiliated fund family ACF. Moving on to studying the heterogeneity in the fund family strategies to produce stellar performing funds. So obviously, I link my findings in section 1.2 and look at the difference between how active and passive families actually engage in producing star performing funds. And then finally, I look into the stellar performance flow relationship. So section 1.1, obviously the pooled panel regressions. So basically in this table, I report the findings of the regression using the net fund risk adjusted returns derived from the CAHA factor and DGTW models as a dependent variable and the fund duration as the key independent variable of interest. So in column 1, as you can see, this reports the results from the first estimated regression at a quarterly frequency. The model in column 1 regresses the fund's net performance derived by the alpha from the CAHA factor model on the key independent variable of concern, the fund duration, while controlling for the logarithm of fund age and size. The estimated loading of 0.071 on the key independent variable, the fund duration, is both economically and statistically significant with t-statistics of 9.6. To give an economic magnitude of such a relationship, a 1 standard deviation increase in the fund duration translates into 190 basis points increase in quarterly fund performance for the average fund. The economic and statistical significance remains relatively stable when we turn to alternative model specifications in column 2 and 3. Since the operating expenses for a fund are calculated yearly, column 2 re-estimates the model, recalculating the variables at yearly frequencies. In column 2, the key independent variable concern shows a positive and statistically significant coefficient. This indicates that on average, the fund duration of a fund by 1 quarter leads to an increase in the fund's net performance by 0.07. The estimated loading of 0.7 on the fund duration is both economically and statistically significant. The results in column 1 to 3 are robust when using the alpha derived from the DGTW holding-based model as a measure of fund performance. Column 4 to 6 report the re-estimated results of the pooled panel regression using the DGTW model. The DGTW model has the advantage over the CAHA as it captures the changes in the loadings on the size, book to market, and momentum characteristics. Column 4 reports the results from the base estimated regression generated at a quarterly frequency. The positive factor loading of 0.048 on the key dependent variable fund duration is both economically and statistically significant. After the inclusion of control variables in column 5, such as the expense ratio, which calculate the end of the year, all variables are recalculated at yearly frequencies. The fund duration still provides a positive and statistically significant coefficient as indicated by the t-statistic of 3.37. Evidently, funds engaging in the detrimental strategy of aggressive trading tend to underperform in comparison to more conservative P funds. Moving on, in this section, I provide evidence on the relationship between an active fund's trading frequency and its affiliated fund family specialization in the active management segment. My aim is to explore the results in the previous section by looking into why funds trade so excessively if it's detrimental for performance. I use three different measures to calculate a fund's trading frequency used previously in the literature, which include the fund duration, the fund holdings turnover, and the turnover ratio. And I quantify directly the degree of a fund family's asset base in the active management segment. Now the results of the models to test my main hypothesis. This table represents the panel regressions of the fund duration on the main independent variable of concern, the family ACF, over the period of 2006 to 2020. Table 7 illustrates the results of multiple panel regressions at quarterly frequency with clustered standard errors. The estimated coefficients of the independent variable ACF across all three model specifications are consistent with the prediction that funds affiliated with higher ACF families engage in higher trading levels. Compared to P funds, mutual funds or fund families with a greater asset-based specialization in the active managements are characterized on average by significantly lower fund durations across all models. Column 1 reports the estimated coefficient of minus 1.36 on the key independent variable, the ACF, which is both economically and statistically significant. To give an idea of the economic magnitude of such a relationship, a one standard deviation, which equates to 21% increase in ACF, would translate into a 344 basis points decrease in the quarterly fund duration for the average fund. However, since the operating expenses of a fund are calculated annually, the estimated regression results in Table 7 are re-estimated at yearly frequencies as shown in Table 8. The results are consistent with the prediction that families with a higher ACF push their active funds, or more so encourage their active funds to trade more frequently. To ensure robustness, I employed two other trading frequency proxies, the fund holdings turnover and the fund turnover as declared by the fund. The table in the following slide displays the results of multiple panel regressions where the fund holdings turnover, capturing the fund's trading frequency, is regressed on the key independent variable, the ACF. Table 9 illustrates the results of multiple panel regressions at quarterly frequencies with cluster standard errors. The estimated coefficients of the main independent variable, ACF, across all models are consistent with the prediction of higher trading levels among fund families with a higher ACF. Compared to P funds, mutual funds or fund families with a greater asset-based specialization in the active segment are characterized on average by significantly higher turnover ratios across all three model specifications. This is consistent with the evidence in all three columns, which report a positive loading on the fund holdings turnover. The base model in column 1 displays a positive coefficient of 0.1852 for the key independent variable, the ACF, with a t-statistic of 5.4. In economic terms, a one standard deviation increase in the ACF translates into a 466 basis points increase in quarterly holdings turnover for the fund. The economic and statistical significance remains relatively stable in columns 2 and 3 after controlling for a host of extra fund and family affiliated characteristics. However, since the operating expenses are computed annually, and as I mentioned before, the regression results in the previous table are recalculated, where all variables are recalculated at yearly frequencies. The findings in the following table remain harmonious with the evidence at the quarterly frequency. This is portrayed in all three columns by the positive loading on the key independent variable, ACF, which is statistically significant in all columns. Finally, Table 11 displays the last set of regression results, where the key dependent variable is now the fund turnover, which actually captures the trading frequency by funds. All three columns displayed a positive coefficient, which suggests that a higher turnover is associated with families with a higher ACF. Section 1.3 looks at the heterogeneity in fund family strategies to produce stellar performing funds. So in this section, I provide preliminary evidence addressing the issue why fund families specializing in active management, as represented by their high ACF, implement such aggressive trading strategies, which actually, as I've shown, have been found to be detrimental and have a negative effect on the average net performance. More importantly, following Nada, Wang, and Zhang, I analyze whether fund families with a higher ACF operate funds with a lotto-like behavior in an attempt to generate star performance. Overall, my aim is to explore the economic mechanism that drives the results and findings of the previous tables, which look at the relationship between the family ACF and the trading frequency of their subsequent fund offerings. Table 12 reports the average number of times in each quintile that funds are ranked in the top 1, 5, and 10% performance bands. Basically, what I do here is I sort first funds into quintiles according to the ACF, right? And then with each quintile, I first sort funds according to their performance, and I take the top 1, 5, and 10 performance bands to truly see the funds which are generating star performance. Thereafter, all the funds are put into quintiles according to the ACF. So as you can see, the results display a monotonic increase in the hit rate from quintile 1 to 5. This suggests that funds offered by families with a higher ACF are more likely to generate top-tier performance. This evidence is complemented by the findings by the findings in the below table, which reports the percentage of funds in each quintile that are ranked in the top performance bands. Table 13 reinforces the findings of Table 12, as it also demonstrates a monotonic increase in the percentage hit rate. Therefore, fund families with a higher ACF appear to be pushing their active funds to trade a lot as they attempt to generate the top rank in performance. The significance of the results is verified by a standard two-sided t-test between quintiles 1 and 5, which demonstrates statistical significance amongst all performance bands. However, following the inception literature, one can argue that funds ranked in the highest quintiles are just younger startup funds which naturally take a lot more risk and therefore are more likely to produce stellar performance. Therefore, it could be that my results are driven by this incubation strategy where funds in higher quintiles are just younger startup funds. I address this concern by computing the time series averages of fund and family affiliated characteristics for each quintile and every performance band individually. This is consistent across the top 5 and 10% performance bands, as you can see in the following slides. So table 14 displays the time series averages of the fund and family affiliated characteristics of funds in the top 5% performance rank. Evidently, my results are not driven by the inception literature, as the age of the fund has no monotonic trend. This is consistent with the previous table of the top 1% and the following table, as you can see here, the top 10%. Which also displays no consistency in the age of the fund. In addition, the monotonic increase in both the average turnover and expense ratio reinforces the belief that active funds offered by families with a higher ACF engage in higher trading strategies. In addition, another notable mention is the volatility, is the increase in the relative volatility of the funds from one quintile to the next. The volatility is determined by taking the volatility of the error term derived from the Caja four-factor model. This result is consistent and suggests that the performance rate of funds engaging in high trading strategies is actually not consistent. I complement this with a Kruskal-Wallis test, which also finds similar results. Moving on to the stellar performance relationship before I run out of time.
You have 1 minute.
Yeah, this is just quick. So basically, this table reports the time series averages of cash flows experienced by star performing funds and other funds within the fund family. The results indicate an upward trend in fund flows for all 3 performance groups. This evidence is consistent with the literature, which discovers a positive relation between past performance and fund flows. More importantly, a similar upward trend is also observed among sibling funds of star performance, which coincides with the findings of Nada, Wang, and Zhang. The results highlight the implication of stellar performance, which sheds light on the rationale and benefits of implementing such high-risk trading strategies. So as you can see in the table, the top row, the flows of the 1%, so these are the flows that are going to the funds of the star performance is positive, and also to the siblings of those funds is also positive, as these funds are also experiencing cash flows due to the star performance of their sibling fund, even though if these sibling funds are actually not hitting the star performance rate. And this is consistent across the 5% and 10% bands. Okay, thank you.